Good afternoon, everyone. Today is Tuesday, 17th Feb. We have what we call CPI on Canada, which is CAD, Canadian dollar. And it's at 4:30. 4:30 Ugandan time, 3:30 South African time today. So everyone is waiting. What is going to happen? I've been talking to some people to see what they think, and it's sad most people speculate actually. They don't even predict, they speculate. So I'm going to give my analysis on Canada, the Canadian dollar. Remember again, CPI means Consumer Price Index. This is the change in the prices of goods. If, let me give you an example, if the price of fuel, the price of gas, if the price of electricity, water bills, grocery increases compared to the previous month, that means CPI will be higher. The percentage will be higher than the previous month. But if those prices of those goods reduce compared to the previous month, it means the CPI is, the numbers are below. So let's look at CPI, which is previously it was negative 0.2%. The forecast, their forecast is expectations, analysts, what they are expecting. They are expecting it to be 0.1%. So they are expecting the CPI to increase. Then the actual is what the data that will come out. So if the data that comes out is maybe 0.2, 0.3, it means it is higher than expected. When it's higher than expected, we call it inflation. It is inflationary. Meaning, if someone has been getting grocery of $10 and it's a lot, it means the same goods, the person may get them at maybe $13 or $12. That means that the cost of living is going to increase in Canada. It means people are going to spend more money on these goods and services. It means people are going to maybe borrow more from the bank. And this creates what we call inflation. Let's look at, there's what, this is CPI, there is also medium, which is, let me show you the medium CPI. Medium CPI, or you can call it CPI year after year. What does it mean? Remember, the data we are receiving today is the data for January. So on the year CPI of a year, it means they are comparing this January 2026. They are comparing it with last year the same month, which was January 2025. They are comparing the data. The previous month, it was 2.5. Okay, the last year, January, it was 2.5. So analysts are expecting it to be maintained at the same level, 2.5. But if it is below what they are forecasting, it means low inflation. It means that the prices of goods last year, January, prices of goods were a little bit higher compared to January this year. But if the data comes out and it is slightly or aggressively greater than the forecast, it means the prices of goods this January were higher than the prices of goods 2025 in January. So what does it mean? For this case, we have next month, we have the Central Bank of Canada, which is called BOC, is going to release data on interest rates. They're either going to cut the interest rates. If they cut the interest rates, you know what happens? the Canadian dollar weakens, because people who are investing in the Canadian bond and all this, they will take away the money to somewhere else because the rates are no longer interesting, or they are no longer good enough for return on investment. So the Canadian dollar will weaken. It means if you are trading USD card, you buy it. But if the data comes, they can also do what? They can also increase their interest rates. If they increase the interest rates, you know what it means? It means the Canadian dollar is going to be strong. Why? Many people will be attracted to the Canadian bonds. So if you are looking at USD card, you are going to sell it because the Canadian dollar is going to gain strength. If they are maintaining there's a time whereby they maintain it. So those are the three options they have. So if CPI today comes out and it is greater than the forecast, you know what it means? It means, remember right now what is happening in Canada. Let me explain what is happening in Canada. Right now, the housing industry, all these big industries in Canada, they are holding on. They're waiting for the central bank's decision next month. They are waiting. Are they going to cut the rates? If they are going to cut the rates, that's what they want. They want to be able to access loans at low interest rates. You get my point? That's what they want. Are they going to increase the rates? If they increase the rates, what does it mean? It means they don't want that. Why? Because accessing the money will be more stressful. Why? They will pay a lot of interest. So if the CPI comes out today and is greater than the forecast, it means that is creating a lot of inflation. And when there is inflation, what does the central bank normally do? The central bank resorts to cutting interest rates. So it means today's data is going to be a signal in Canada or anyone, even any trader in the world. Today's data will be a signal. The central bank will cut rates next month. So if it comes out higher, it means somehow the Canadian dollar is going to weaken. Why? Because everyone is expecting the interest rates might be dropped. If it comes out lower, the Canadian dollar might buy, basing on what they expect next month. So it means in the first few minutes of CPI release, it will react to this. If it is greater, it means they will first pump and buy. Then it will later set a trend basing on what these guys are expecting to happen next month. I hope I'm clear. I hope I've explained it well. So let's wait for CPI. Just know if it comes out higher than the forecast, what does it mean? Creates a lot of inflation. It means for those few minutes, 1-2 minutes of the first CPI release, it means the Canadian dollar is going to pump. But later on, remember what I said last time. CPI for a year, it is the one that sets the trend. After all the madness that happens, the volatility in the first few minutes, the market normally chooses to trend in the direction of the CPI of a year. If the CPI of a year is comes out maybe when it is greater than the forecast, it means generally the Canadian dollar is going to buy. It is going to trend upwards. Then another thing, if it comes out lower than forecast for a year, it means the Canadian dollar is going to weaken in the longer, like in the, let's say the 30 minutes after the CPI, one after the CPI, the trend will be respecting the CPI for a year. So the core price index of a month, it normally creates this fast volatility in the first few minutes. But remember, all these things will be generally referred to what these guys are expecting on the interest rates next month. So I believe I've explained. Let's wait for 4:30. I'll make a video reacting to this. I know I'm going to be 100 spot on. Thank you. Okay, wait, okay.